Hey everybody, hope you're doing great today. This is Paul. Today I'm going to talk to you about interest rates and your mortgage monthly payment. So obviously there's a direct correlation. The higher your interest rate is on your mortgage, the higher your monthly payment is going to be. So your monthly payment breaks down into a principal and an interest portion of the payment. So basically with that, at the start of the loan, most of your payment is going to be going towards the interest portion of the loan, and you'll be getting a little bit towards the principal portion of the loan. This happens, it's basically set up through an amortization table, and through that, the payments will shift over time. Rather than paying more in interest at the beginning of the loan, you're going to be, over time, that's going to be flipping. So at about the midpoint, you'll actually be paying more in principal versus the interest of the loan. And that's just the way the loan is built. And for this one, we're looking at a 30-year fixed rate mortgage. Your ARM mortgages are a little different. The adjustable rate mortgages, they are a little different because the rates can adjust. And so how much interest you're paying can vary over the term of the loan. But with regards to the fixed 30-year mortgage, even with regards to, let's say, a fixed 15-year, 20-year, if you have a fixed rate mortgage, it's going to apply similarly, just rather than 30 years, it'll be 20 years, 15 years, what have you. So as you pay more in interest, so not only are you having a larger monthly payment, just for example, I'm going to flash an example up here on the screen of a $400,000 house. We're comparing the interest rate with a 6.5% high rate, and a couple of years ago, people were able to get a 3.5% interest rate. So a difference in 3%. But if you look at the numbers, let's say we start with the 3.5% at a $400,000 mortgage, here's what your payment is going to be. So that's your number right there. That includes both interest and principal. It does not include your escrow. Escrow is going to be your insurance, taxes, and potentially any HOA fees. So those will be included later on depending on what type of loan you have set up. If you are greater than 80% LTV, so you're putting down less than 20% on your mortgage, usually an escrow is going to be required for you. It's usually optional if you put more than 20%. You can pay it directly if you prefer, and you don't have to use an escrow, versus some people prefer just everything to go into one payment. It's going to cover your insurance, it's going to cover your taxes, and once those bills come due, the mortgage company, the mortgage processor is automatically going to pay those, so you don't have to worry about those while you own the home. But that's a topic for a different video. We'll cover escrow and insurance, taxes, and whatnot. We'll cover that in a future video. So with the interest, as I noted, showing you there again the amounts that you're going to pay. Here's your 3.5% loan fixed for 30 years. This is what you're going to pay on a monthly basis. So at a fixed rate, that means it's fixed for the life of the loan. The principal and interest portion of that will not change for the 30 years as long as you own that home and as long as you have that original mortgage. Now, if you refinance, you move homes, you get a different mortgage, that changes things. So now let's look at the numbers with a 6.5% interest rate. So same home, $400,000, 30-year fixed mortgage, and a 6.5% interest rate. Today, as of making this video, whenever it's been posted, we're looking at around 6.5% for your mortgage rates. It's going to vary based on person to person, based on your credit score, how much you're putting down, what type of loan you're getting, VA, FHA, conventional. So it will vary. In general, the average rates you can see quoted on these platforms are around the 6.5% range. So based on a $400,000 loan, here's how much you're going to be paying with a 6.5% interest rate. Here's the difference between the 3.5% and the 6.5% rate, and this is your monthly payment. So as you can see, there's a big difference in these payments. So assuming the prices of the home stay where they are, $400,000, now that you've got a 6.5% rate compared to a 3.5% rate in the past, obviously that affordability equation changes quite differently for people. So a lot of buyers have just stepped out. Home prices either need to come down, their incomes either need to go up, or interest rates need to go down. So far, nothing is really happening in that sense. Incomes might be slowly ticking up. You've got inflation going up as well too. You've got activity going right now in the Middle East too that's kind of changing the factors of things. So right now that things are kind of frozen. Many buyers are like, I can't afford this, 6.5%. The current housing prices is just outside of my budget. It doesn't work. I'm either just going to stay. If I'm an existing homeowner, I've got a low rate, I'm going to stay where I'm at. If I'm currently renting, in some markets it makes sense to rent. You can actually get a better deal renting versus purchasing a home. Generally, your maintenance is going to be covered by the landlord, versus you own a home. A lot of times the maintenance is coming out of your pocket, unless you have some sort of home warranty or something like that, and that doesn't cover everything. So leaving aside the monthly payment differences that we showed there earlier, let's look at the overall interest payment. So basically, if you stay in that home the entire 30 years, you have that mortgage for the entire 30 years. For the 3.5% interest rate, this is how much interest you're going to pay over the life of that loan. So now let's look at the 6.5% interest rate on a $400,000 mortgage over 30 years. This is how much interest you're going to pay over the life of the loan. As you can see, over the life of the loan, that is quite a huge difference, even though you're only going up 3% in terms of the interest rate. But it's a huge amount of money that, with a lower interest rate, you could obviously save that money, put it into your own investments, put it in your own retirement account, spend it towards yourself, versus now with a higher rate, you're putting that money that's going basically to the bank's balance sheet. So it's a huge difference there, as you can see. So that's why a lot of people will try their best to get a lower interest rate. And in order to best do that, there's a couple different steps, suggestions I can provide to you in terms of getting a better interest rate. So the earlier you start, the better in terms of working on your own personal financial situation to get the lowest rate possible. And the primary way to doing that and starting early is focusing on your credit score. So paying down excess debt, making sure your bills are paid on time, making sure you're not borrowing too much money. If you got too much debt, your debt to income ratio is going to be in a problematic situation, and even to an extreme, whereas if your DTI is completely outside of the boundaries that the lenders are going to require, you won't be able to get any mortgage whatsoever. So work on paying that debt down. Refinance if you have a high interest rate debt, refinance it, consolidate it, put it into one loan, and then start paying that down as soon as possible, so you don't have to worry about that when it comes time to applying for a mortgage. General rule of thumb is the higher your credit score is, the better interest rate you can get on a mortgage. So another option for getting a lower interest rate on your mortgage is to put more money down. So your LTV, rather than doing, say, putting 10% down, if you put down 20%, 30% or more, the banks are more comfortable with that. It's less risk for them, so they're willing to give you a lower interest rate as a result of that too. Also check your loan programs. Not every loan program will give you the best rate depending if you qualify or not. There's your FHA, your VA, your USDA, your conventional. So depending on what you qualify for, if you qualify for the VA mortgage, basically you're a veteran and you meet the criteria, you can actually go by with a very low down payment, 0% in some cases, and also get a low interest rate for your loan too. So it pays to ask questions, find out what you qualify for. FHA's, it's got different rules. Most pretty much everybody qualifies for FHA. The nice thing about FHA is if your credit score isn't the best credit score with the FHA, usually you can get into the loan, assuming you meet the minimums, you still meet the DTIs. Just understand you're going to be paying some upfront mortgage insurance premiums and paying a monthly mortgage insurance premium. Versus a conventional, if you're putting down 20% or more, you don't have any private mortgage insurance, which is an additional fee that you pay on a monthly basis. But with that fee, doesn't go towards your principal, doesn't go to your interest. It's basically you're paying an insurance policy to make sure that in case you do default, the lender has some way to get their money back. Now, like I mentioned, if you put the 20% down, that's fine. If you put down less than 20%, chances are you're going to be paying a PMI in order to get that conventional mortgage. FHA has what they call an MIP, similar to the PMI, and you also pay an upfront fee as well. VA does not have that fee, but they do have a upfront funding fee that you might be eligible to waive depending on conditions. That you need to talk with your loan officer, reach out to them, and then ask them questions. If you're a veteran, do you qualify for waiving of that funding fee? USDA mortgage applies to certain areas. It's more rural locations, lower amounts. You can also get a 0% down payment on those with a lower interest rate. So another way you can get a lower interest rate is by what they call mortgage buy downs, paying points, mortgage points. It's basically you're putting money up front in order to buy down your rate. And sometimes those buy downs are temporary, which means they last for a couple of years. Other times they can be permanent. They are the entire term of the loans. So if you're getting a 30-year mortgage, a buy down could be for 1, 2, 3, 4 years, however you set it up for, or it could be for the life of the loan. And you need to do the math on that. Compare your numbers. How much are you putting up front to buy down that interest rate? How much are you going to be saving over the life of the loan? Now, there's always people who say, hey, on average, people live in the home for 5 to 7 years, which is true. You sell the home, you go buy another home, you get another mortgage, so that changes things. But over the life of a person, you're going to be living somewhere, and if you're paying a mortgage, you're paying a mortgage the entire time you're living in that house unless you pay that house off. So even though, on average, people live 5 to 7 years, look at the overall numbers as well too. How much money are you saving by buying down your interest rate? How much money are you saving by getting a lower interest rate overall? Do that math. Make sure you understand those numbers. Another thing to do is to shop around. So once you apply for a mortgage with one company, complete application, they're required to provide you with a loan estimate. And what a loan estimate is, it gives you a better way to compare numbers to a different lender. Chat with a couple of different lenders. Usually they can't give you great numbers, final numbers, until you get that loan estimate. They get your full application in. Once you have a loan estimate from one, you can compare it to the other, and by all means shop around. Some lenders don't like that, but unfortunately, as a home buyer or borrower, if you're refinancing, you need to compare your numbers because you're in it for yourself. You're trying to save money for yourself. You're not trying to fund the bank's 401k plan. You're not trying to fund the bank's stock purchase plan. You're trying to save money for yourself. So compare the numbers. Make sure you're comparing like numbers to like numbers. Yes, interest rates do matter. If this one lender has 6.25% interest rate, this one has 6.5%, but this one is charging much higher fees, and then you have to either pay those fees up front, that increases your upfront cost, or you're financing that into the loan, then your overall payment is going to go up. So compare not only your payments as well too, your interest rate as well too, but look at all the fees over there. Where are you saving money? And then work with those lenders that you think can best suit you. So if you have any questions, feel free to reach out to me below. My contact information is below. I do lending myself, and I'm also a real estate agent here in the Ohio and Kentucky area. So reach out to me in my contact information below. If you do have any thoughts or comments for future videos, drop those ideas in the comments below. Thank you for watching, and I'll see you in the next video.